Welcome to The Explainer. Today, we're going to break down a truly shocking market reversal. A day that literally vaporized trillions of dollars and left pretty much everyone asking, what just happened? So picture this, November 20th. The market opens with a bang, but by the close, a $2 trillion wipeout. Yeah, in just a few hours, all that morning optimism just vanished, replaced by this huge wave of selling that left everyone reeling. So let's get into the story of how it all went down. Okay, so the day starts off great, right? It looked like we were in for a strong rally. Tech stocks were just flying, all thanks to some really fantastic news. But then, bam. Midday, a sudden shift turns that awesome rally into a complete and total rout. I mean, the Nasdaq had this wild swing of over 4.6% from its high to its low. So the big question is, what on earth flipped that switch? All right, so let's start digging. The primary trigger seems to be this sudden, coordinated, and very public message from the U.S. Federal Reserve. And get this, it wasn't just one person speaking. It was like a whole chorus.
First up, you had Cleveland Fed President Hammack. He basically came out and said, hey, financial conditions are already pretty loose. Money's easy to get, asset prices are high, and he warns that cutting interest rates right now could just pour fuel on the fire and create some dangerous market bubbles.
And then, almost right after that, Fed Governor Barr jumps in and doubles down. He's pointing out that inflation is still stuck at 3%, which is way above their target. So the message was, we have to be super, super careful about easing up. And just to make it a trifecta, you had Chicago Fed President Goolsbee voicing his own serious doubts. He's looking at the latest inflation data and saying, I'm seeing some unsettling signs here. Things might even be heading in the wrong direction. And that was pretty much the last thing the market wanted to hear.
So, look, nobody came out and said the exact words, there will be no December rate cut. But they didn't have to. The collective message was crystal clear. Wall Street had been pricing in a cut, and now, suddenly, they had to completely reset those expectations. Just like that, the hope was gone.
Now, here's the thing. The Fed's words didn't just land in a vacuum. Nope. They hit a market that was already struggling, trying to make sense of a really mixed bag of economic news. It was basically the perfect setup for uncertainty.
I mean, just take a look at the labor market. It was giving off totally conflicting signals. On the one hand, you had job growth that was way stronger than anyone expected, which, sounds great. But at the exact same time, the unemployment rate actually ticked up to 4.4%. So what is it? Good news? Bad news? Investors were completely lost with no clear direction.
Okay, so this incredibly violent reversal, it wasn't just about that one day's news. If we really want to understand why the market had such an extreme reaction, we got to look beneath the surface. The truth is, the market was already pretty fragile, kind of standing on shaky ground. There were a few things going on in the background creating this fragile foundation. For one, cash, liquidity, was getting tighter. Key stock indexes were bumping up against these major technical ceilings. These price levels, they just couldn't seem to break through. And this is a big one. You had these automated trading programs, the quant funds, just sitting there programmed to sell at the first sign of trouble. They were basically ready to pour gasoline on any fire. And you could feel this bearish mood growing. It was perfectly captured by the famous investor Michael Burry. He posted this really sharp critique of AI companies, the market's hottest sector. He was basically asking, is the demand here real? Where's the revenue? He was suggesting that under all that hype, the foundation was just weak. So you take the Fed warnings, you add the confusing data, you mix in that fragile market setup, and what do you get? A perfect storm. And it created this huge split in the market. It became a classic risk-off day. That means investors were just dumping anything that seemed remotely risky and running for the hills, looking for safety. And oh man, NVDA is just the perfect example of the heartbreak that day. So get this. The company reports a fantastic, absolutely blowout earnings report. The stock just soars at the open. But in an environment this fearful, the good news just didn't matter. The stock did a complete 180 and ended up closing deep in the red. Just brutal. But then you have the other side of the coin, Walmart. The retail giant basically became a safe haven. Now, they also posted strong earnings and raised their outlook. But here's the difference. Walmart is seen as this stable, defensive company. So what happened? Its stock surged nearly 6.5%, completely swimming against the tide of the market crash.
This is what's so fascinating. It perfectly illustrates the psychology of the day, right? You have two companies. Both have pretty much identical, amazing news, great earnings, strong outlook. But the outcome for their stocks? Wildly different. And it all came down to one thing: investor fear. Did they see the company as risk or as safety? So that brings us to the big question. When you see a day with this much intense, widespread selling, this much panic, what does it actually tell us? Is it just a warning sign of more pain to come? Or could it be something else? Well, a really important clue might be found in a single number, 28. That's where the VIX index, the market's fear gauge, spikes to during the absolute peak of the selling frenzy. So the VIX is basically just a measurement of pure raw fear in the market. As it climbs higher and higher, especially as it gets close to that 30 level, it's a huge signal that panic is setting in. It's the point where investors just throw in the towel and sell everything they own. It's a moment we call capitulation. And what's cool is this follows the classic pattern for how market bottoms often form. So here's how it usually goes. First, the big momentum stocks, the leaders, they start to decline for a few weeks. Then you get a sharp, painful, broad sell-off that hits everybody. That in turn triggers the big spike in the VIX, the fear gauge. And finally, you get that capitulation, the point where the sellers are just completely exhausted. And historically, that's often a sign that the correction is finally burning itself out. Which leaves us with one final, kind of provocative thought to chew on. A day that wipes out $2 trillion? Look, that's terrifying. That kind of intense fear can be absolutely paralyzing. But if you look at market history, it often shows us that it's at that precise moment of maximum panic, when literally everyone is selling, that some of the greatest opportunities quietly begin to show up.